Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios today for today's podcast, post the latest CPI inflation, headline inflation news. So a lot to talk about here, right as we're in the last 5 minutes of today's market close. Definitely not the reaction that I was expecting from the broader indices, although I'm very encouraged about some specific sectors that I'll talk about here in just a little bit today. But today is Inflation Day. This is something that we've been preparing for our clients really since last year. And since the beginning of this year, this is a day that we were anticipating and expecting that finally you start to see owner's equivalent rent start to fall over, otherwise known as shelter, the shelter component of inflation. We've been talking about this all year long, two pieces of the CPI headline inflation number being propped up by auto insurance as well as shelter. And those things are breaking as we speak here and have been breaking for a while. It's just finally showing up in the actual official data that the Fed and the rest of the market looks at. So that's the main topic today, Ez. I'm definitely wired and ready to go for this one. Not only have been talking about this for a long time, been talking about this with clients all quarterly review. We got the news today. Reaction in a one-day perspective isn't what I was hoping for, but very, very excited for the back half of this year. So before we get kicked off, man, what's going on with you? I see you got some stuff in the background there you've been working on. Looks like anything happening in your world you want to let the audience know about?
Yeah. Thank you. Yeah, got some new artwork additions in the background. Heard today that I am going to be featured in a gallery exhibition in your neck of the woods, Cincinnati, Ohio, Manifest Gallery. We got an exhibition coming up starting August 15th. So kicking off that. And, just on my general grind for the audience that doesn't know, when I'm not pretending to be a finance finance partner of Shepherd Wealth Management on the podcast, I also am an artist, a visual artist. So that
Yeah,
never
man.
ends. I wake up in the morning compelled to make things that no one cares about, and I go to bed compelled to make things no one cares about. So
Hey, man, I love it. And congrats on the art show. I did hear about
thanks.
that. Excited for you. And definitely, I know everybody appreciates the video stuff that you do, the editing and all that. And I know that we get good feedback from it. So definitely not possible without your skill set. And obviously, my skill set plays pretty well here for my job and what we're doing here on this podcast. So I couldn't do it without you, buddy. Certainly
Oh,
appreciate it.
that means a lot coming from you. The audience knows, and you do too, man. I'm a huge fan of you, and I really do love working with Shepherd Wealth Management and you specifically. So it's my pleasure, really.
A lot of fun. We've been enjoying this. This is our fourth season, something like that.
Season 4, I think third year though. We had a kind of a truncated season 1.
Yeah,
We were doing all those interviews and kind of figuring out what we wanted the podcast to be.
that's right. Thousands of videos later, here we are.
Quite actually, thousands of clips at least. But I think this is probably our close to, I have to check for sure, but I know we're approaching 70 episodes of the podcast. And, we do those bi-monthly. So about 2 to 3 a month. So that's pretty good. And they've kept pace with the life of the firm as well. And it's grown as the firm's grown. So
Absolutely. We look forward to continuing delivering this. And for those that don't know, and maybe this is your first time checking out the program, welcome. Glad to have you. Don't forget to like, subscribe to the channel. That way, when we drop these things, you're first to know about it. But really, what we do this for is our customers at Shepherd Wealth Management. I mean, obviously, we're doing this on YouTube's platforms. This is available to everybody on the internet, and certainly hope those that are watching, listening, are getting a lot out of it. But the primary reason why I do this show is because I know that in today's AI world, this technology world that we live in today, everybody's updated regularly on their smartphone as to what the headline news is. And the headline news isn't the problem. The news is doing their job of informing the public, but what the news does a terrible job of, in my opinion, is they do a bad job of providing historical context. And what I mean by that is the news is a business, and they want eyeballs on the screen. Doesn't matter what kind of screen that we're talking about. The longer that you're on there and clicking around, the more valuable that news outlet is in the form of selling marketing ads. So the longer you're there, the more money they make. That's the model. There's nothing wrong with that. what they do a good job of is understanding who human beings are. And we are emotional beings. We haven't changed all that much in a couple thousand years. We're hardwired with these emotions called fear and greed. And behavioral finance, the study that you can get a PhD in these days, has explained to us that human beings feel losses twice as much as they feel good about making a gain. Therefore, we are risk averse by our hardwiring, our nature. And that's not a bad thing per se, but the news understands all this, of course, so they tend to placate to that fear emotion because, again, you feel that more than even about good news. And because of that, that's how they're able to sustain their profitability and be in business and sell those marketing ads. There's nothing, again, wrong with that. But what we try to do here is say, hey, here's what's going on. This is what you saw in the news here today or this week or this month. Here's why it's important for you to know about it. But oh, by the way, here's the other periods of time that we've been through something very similar. And most often is the case. There's usually 10, 15, 20 or more instances where we've been through something very, very similar as to what that headline risk is. And you can kind of look at what history had to say over that period of time. And here's how human beings reacted. Here's what the market looked like and all the sector's performance over those circumstances. And all that does for an individual investor is two very, very important things. One is it controls your emotions, your temperament, right? Again, you see that headline risk, whatever that is, it kind of immediately hits you in the stomach, if you will, makes you feel very queasy and nauseous. And then what are you going to do with that emotion? Well, if you're busy, like most people are throughout the day, you're probably going to stick in the back of your mind somewhere. It's going to cause some anxiety. So this program is all about saying, hey, here's what happened, but here's what history has to say about it. That way you can calm down and say, yeah, you know what? It's not great to hear that news, but we've been through this 17 other times in the last 100 years. And actually the outcome wasn't so bad, right? That's the first thing that we're doing here. And the reason why that's important is Warren Buffett, in my mind, is the best investor of all time. I think that would be hard to argue. But the number one reason why he believes the individual investor does not achieve the results they're looking for consistently is because they have no control over their temperament, of their emotions. So that's the first and foremost reason why we provide this program and this content. The other reason is now once you understand what the probabilities are, how other human beings, that's what the market is, by the way, is a whole bunch of human beings. Some of you might be saying, well, what about the algorithmic trading and whatnot? Well, human beings had to create the algos as well. So I throw them into the exact same category. And, once we get an understanding of how human beings have behaved under those circumstances in prior times in history, all you're doing is you're putting probabilities in your favor, right? It's not a guarantee of future results. We've all heard that disclaimer that the investing involves risk and past performance is no guarantee of future results. All that's true. All that deserves to be disclaimed. But all we're trying to do is, one, control our emotions with that historical data and say, you know what? Human beings haven't changed all that much. Now we have these probabilities. Let's start to make an asset allocation decision. And that actually is what drives 94% of investors' return, is the way that they've split up their money between stocks, bonds, and cash. It's otherwise known as asset allocation. That's why this program is so important. We're trying to fill the gap that the news seems to leave out here for us. And quite frankly, it's given us quite an edge here at Shepherd Wealth Management for our customers from a performance standpoint. And we've been highly regarded from a performance standpoint. It's part of the reason why we're at $100 million in 3 years for a RIA firm right here in Northern Kentucky, Cincinnati area, serving clients across 11 states. So very excited to be able to do this program. Is certainly an honor and a privilege. Take it very seriously, and today is one of those very serious days. Headline CPI came out this morning, and let's just go over some of that information here with the audience. Because, again, the news being the news, didn't really break this down as well as I would have liked them to, but here's the actual data. So June core CPI came in at 8:30 this morning. The number came in at 0.06. So again, 0.06 month over month. The market was looking for 0.21, right? So this is more than 3 times better than what analyst economists had expected this core June CPI inflation number to be. I mean, that in and of itself, that statement, again, wasn't said on CNBC today at all or any other news outlet that I'm aware of. That statement was never made. More than 3 times better, lower than expected inflation. inflation is in fact falling like a rock. I mean, this is now the third month in a row that we've seen lower than expected core CPI inflation. I mean, flat out, things are falling faster, like we've said all year long. Things are falling faster, much more so than the market is pricing in, and much more so than the Fed is actually giving credit for. Now, to the Fed's credit, Jerome Powell's been giving Senate, testimony for the last couple of days, and he has actually brought up the fact that there is greater risk of keeping rates where they're at today, between 5.25% and 5.5%, than there ever have been. Meaning that he's worried about, destruction of the labor market. All this great work on inflation. Inflation peaked out 2 years ago, 2 summers ago, at 9.1%. The year-over-year inflation number that we got today is at 3%. If you actually look at the core numbers, inflation basically is at 2%, which is where the Fed target is. When you look at it, if you annualize these numbers over a 12-month period of time, you're essentially right there, which is why Jerome Powell came out in front of senators and talked about the risk of leaving rates where they're at. Mary Daly came out this afternoon, a Fed chairwoman, and she's talking about the need to adjust policy, meaning that there's a higher need to go about loosening policy as opposed to keeping things exactly where they're at here today. All of these things are extremely bullish for investors and extremely bullish for the general stock market. This was such a good report, mostly due to the fact of the things that were holding up the headline CPI number all year long. Again, we talked about it at the beginning of this program, and I've talked about it all year long for six straight months, it feels like, is that shelter, the biggest component of the CPI calculation, shelter only rose 0.2 month over month, and this has been breaking the pattern of 0.4, 0.6. So again, this is 50% better than what a lot of people were expecting on the downside for shelter. This is just the lag effect that we've talked about all year long with shelter and auto insurance, and both seem to be cooling. And this is why we here at Shepherd Wealth Management expect inflation to continue to fall like a rock, because the other components, like we've talked about again all year long, all the other components, everything outside of auto insurance and shelter, all those other components are largely back below their pre-pandemic level. So over 55% of the other components that make up CPI are actually below their pre-pandemic inflation numbers. This is just fantastic across the board. The September Fed funds futures rate now sees an 85% chance of a Fed cut in September. And I was actually on the Fed's website here prior to today's podcast, as you can probably imagine, just checking out some probabilities of rate cuts. And for July, so the Fed meets July 31st and makes an announcement. There's only an 8.8% chance that they cut, according to the Fed Watch tool that I'm looking at here, which is a CME Group website. There's a 91, 92% probability that they don't do anything. And that to me would be a damn shame. These guys have been talking about being data dependent for forever. And that's a good thing. You should want to be able to get data in order to make informed decisions. But this is inflation that's been falling across the board all year long. And now you're finally, 6 months into the year, finally seeing the largest component of inflation falling. If you watch the news at all, if you follow any of this stuff the way that I do, to a small degree, you probably know who Jeremy Siegel is. And if you don't, just Google Jeremy Siegel. He's a professor at the Wharton School of Business, University of Pennsylvania. Outside of Warren Buffett, he's pretty much the other person that I truly enjoy following, respect him a lot. He uses forward-looking indicators for a lot of the evaluation that he does relating to the economy, the markets, and the Fed. And the Fed has all the same research data as any professor at any university. This has nothing to do that's special with the University of Pennsylvania's Wharton School of Business, right? These guys don't have the data nobody else does. Everybody has it. So Jeremy Siegel, Professor Siegel, who actually was a professor for most of the people that you see on CNBC's halftime show, by the way, like those guys and gals were literally in this dude's class. not that long ago. Um, Needless to say, he's using the Case-Shiller index, the home index. It's public information. It's updated almost every month. It is what we call forward-looking economic indicators. And he uses that same formula that the Fed is using. He's just using real-life housing data, Case-Shiller. And you're already there. You're already at like 2.2% CPI, headline inflation. And he's been talking about this all year long, just as we have. And it's extremely frustrating that the Fed is using backwards looking indicators such as CPI. CPI, by the way, is by definition a backwards looking indicator. The data is a month old, and you get these two huge components, mostly shelter, that has this massive, usually historically an 18-month lag effect before all that data starts to actually show up the way that it would be real time. So that's why you see Jerome Powell kind of squirmish in front of these senators here in this testimony, is because they have two mandates. One is maximum employment. We've been under 4% on the unemployment rate for years. We just cracked 4.1. Just cracked 4%. We're at 4.1 unemployment rate right now. That's not really the problem. 4% unemployment rate is considered maximum employment according to the Fed. So that box has been checked for them for a while, but they do not want this progress on inflation to all of a sudden just destroy the economy for no reason, just destroying jobs and the outlook for future growth prospects for the U.S. economy. They do not want to do that. They have a dual mandate. One is price stability. That's inflation. To me, that inflation, is broke now. They've broken that camel's back. Now it's time to worry about the other mandate, and that is maximum employment. They've had that box checked. I don't think they want that to get away from them. But certainly not during an election year, even though they are a separate entity. It has nothing to do with the White House. They're completely separate, which is a good thing. But let's be honest, we're all humans. They probably have their favorite candidates, just like you and I do. And it would be helpful for the general population to have some easing of price pressures. And when you reduce interest rates, it doesn't have to be political. It's going to help everybody. Everybody that has a credit card balance, that balance will immediately have less interest charged on it. There's a lot of things that would be very beneficial from the housing perspective. We need about 5-6 million more homes than we actually have. That problem will not be solved the day that they cut interest rates. But there are a lot of things that this economy certainly needs, and they need a Fed that is forward looking. And this is the problem that I've had with the Fed all year long. They're starting to play with a little bit of fire here. And if we keep rates too high for too long, something eventually will break, no question about it. And you're basically stealing, a huge opportunity for a soft landing here, in my opinion. So going back to this CME Group website with Fed probability tool of interest rate cuts versus staying the same, it seems as though, based on these probabilities, that Fed Chairman Jerome Powell will not have the intestinal fortitude to do what is right and start the rate cutting cycle. And by the way, he's only going to cut rates by 25 basis points. What's the difference if you cut by 25 basis points at the end of July versus the beginning of September? It means freaking nothing. Absolutely nothing. You're going to cut rates by 25 basis points and people still think there's going to be some spike in inflation all of a sudden. That's absolutely ridiculous.
Yeah, I don't even know much about this stuff, but I do know that that's pretty ridiculous, man. From how we've seen just the 25-point increases and like when they've been planned and sometimes when they haven't and how long that takes to cycle in, all that stuff. Yeah, I don't understand what the lollygagging is about this,
Yeah, this is a lot of lollygagging. There's no question about that. And it's unfortunate. They need to have the intestinal fortitude to do what is right, as opposed to being like, I got to be more confident. Well, it's not going to get much more better than this until you actually hit 2%. But Powell's already come out and said in prior meetings to the general public, like, hey, we can cut rates before CPI gets to 2%. It's about that time, buddy. It's definitely about that time. And I am definitely pounding the table for a July rate cut. I think we should get 3 at this point. Even if we do not get a rate cut in July, they still have time to squeeze 3 in, given the fact that they will meet in September, November, and December. I don't think that they want to wait around another extra couple months just to reduce interest rates by 25 basis points, but he might. And if you actually look at the probabilities, there's a 93% chance that there is a rate cut in the September meeting, mid-September, around the 18th. If you go to November, 96.7% chance of an additional rate cut. And when we get to December, there's virtually a 100% chance. So the market's pricing this in real time as we speak. You would have a very difficult time convincing me that there's no good reason to not cut interest rates by freaking 25 basis points by the time we get to the end of July here. I can't imagine the Fed actually getting in front of the national audience and trying to make a case for why they're not cutting interest rates, why they're going to hang on this extra 25 basis points for another couple damn months. It would make no sense at all. I can't even imagine that happening, but according to the probabilities here on the CME website, it seems like it.
Let me ask you something, and I want to phrase this without trying to sound, and I know the term conspiratorial, right? But I mean, I'm sure we all remember the scare we had with regional banks just
Yeah,
about a year and a half ago, was that right? And that
about
was
right.
kind
Yeah,
of a wake up call for Powell where he realized maybe I need to at least slow the brakes on this hikes and stuff. We talked about all that. Do
right,
you think in
right.
the back of his head, maybe he's looking for a sign like that, that's the confidence he's actually needing? Not to say that he's trying to like crash anything, but like,
Yeah,
is that maybe what he's actually saying? Because the data, as you said, continues to go in the way he says. And like you said, what's 25 points going to do but just make everybody feel safer, right?
yeah.
So is he waiting for an event like that to happen? Is that like what he's kind of code talking about? Do you think?
I, I can't imagine. I mean, that would basically be, rooting against uh, not just investors in the market. That would just be like rooting against America, essentially, right? So I don't believe that to be the case at
Okay,
all.
good.
I, I do think that they want to be quote unquote confident, but I mean, economics is not an exact science, right? You're using forecasts, you're using variables. I mean, you're using actual real life data. I'm not saying that, economists are just picking stuff out of thin air and coming up with a number or a statistic. There's really good ways to measure certain things in the economy. There are a couple of things that we really are terrible at measuring. One of them is owner's equivalent rent, what they call shelter component of CPI. That needs to be thrown out, right? It's not going to get thrown out because you're dealing with decades worth of precedent and history and all this other stuff. But I think that a Fed chairperson really needs to be realistic about using the technology that's actually at our fingertips here. We can use forward-looking indicators. We don't have to do this just because other decades did it prior. We have better information. We can analyze it faster, and we can do a better job of making decisions if we use the old school method and kind of blend in some new school thoughts. Again, Jeremy Siegel, I pointed to that. He's teaching that at the Wharton School, where, again, most of the people that you see on Fox News and CNBC, all those cats, studied underneath this person. So again, the Fed's not ignorant to all this stuff that we're talking about here today. They could choose to do certain things differently if they wanted to. But at this point, now they've gotten inflation completely in a headlock. It's time to take the foot off the brake here as it relates to the overall pressure that interest rates put on the economy and corporate America, as well as individual Americans here in this country. So to answer your question, I don't think that's what he's trying to do. I don't think he's like twisting his mustache and seeing what community bank he can have suffer the most up until the point to where he has to make a decision.
Yeah, and just for everybody and you as well, I wasn't implying I thought he was trying to crash something. I just didn't know if maybe like his idea of being confident was seeing some kind of like explicit indicator that it's time to turn the course rather than just him doing what he's hired to do and to use his judgment and conjecture, right?
Yeah, I'm with you on that. I mean, to me, it's just as simple as this number that we got today, more than 3 times better than what economists and analysts were expecting. And then think about it this way: the last couple inflation reports again came in lower than expected, but we were running at zero point 0.3 core CPI for multiple months in a row. in 2024 this year. Now we go from zero point 0.3 last month to 0.06 when economists were expecting 0.21. I mean, this is way better than the news is giving any credit for. And the only thing that I'm seeing on CNBC right now, as we're talking here about 20 minutes after 4 o'clock, is they're calling for, are there recession fears out there? How in the hell could you have recession fears with maximum employment, falling inflation, strong GDP, and back-to-back earnings quarters that were nothing short of astounding? So this is why we always talk about, here's what the headline news says, but here's what history has to say. Let me provide some historical stuff with the listeners here today. History shows that stocks in a strong first half of the year, which we just have, outperform in the second half. Thus, we are favoring the S&P 500 names here at Shepherd Wealth Management have done very well for us. And we're really looking at positions that have done better than 30% in return in the first half of this year. Believe it or not, you're looking at about 31 different companies that have been able to do that. And history has shown 3 consecutive years in a row that sticking with the winners, your first half winners, pays off. So that's exactly what we plan on doing here at Shepherd Wealth Management, where we're not just really sitting on our hands. We've talked about the 3 areas that we've really overweighted for our customers that have helped us outperform so far this year, that being technology stocks, industrials, and small caps. Yes, we have a little bit of biotech and a little bit of healthcare, a little bit of financials, but most of the portfolio for our customers are in those 3 asset classes. So tech was awful today. As I'm sitting here right now, markets already closed. The NASDAQ, the tech sector, was down 1.95% on the day. So I'm going to start there. So again, we've had 2 straight quarters of just phenomenal earnings, 2% GDP, which is historically average, still good. Inflation's falling like a rock. You're seeing that today. But somehow, investors in tech names, Amazon, Apple, Google, Microsoft, NVIDIA is down over 5% today. All of these positions are basically down more than 2% today on the back of that amazing news. So first of all, if you're one of those caps that decided to sell all of their shares of the best companies on the planet, the most powerful and profitable companies on the planet that have done so well in the first half of the year, I just told you history pays to stick with your winners, right? If you're one of those people that sold any of those shares today or sold all of those shares today and bought anything else, doesn't matter what you bought. If you sold those shares, you need to step away from your desktop, leave the mouse alone, and fire yourself. I'm just telling you what it is. You can hire us if you want. Give us a call. I know that we'll do better. But you are not the best person for that job, right? Just have a real conversation with yourself here. And it's not my opinion. This is what history has to say. We'll just start with that. What did do well today, again, something that we have anticipated and talked about all year long, was small caps. Small caps absolutely crushed it. So we are in the IWM, which is the iShares Russell 2000 Index ETF. It tracks the small cap sector. That was up 3.59% today. Okay, so we've talked about this. There's a reason for this. It wasn't just because everybody said, this is what you're hearing in the news. Everybody's like, well, why is tech down? Everybody's like, oh, there's this rotation. Everybody's selling their tech shares and going to small caps. If you sold all of your tech shares and went all in the small caps, again, fire yourself, right? That just doesn't make any sense at all. Now, I will say this that does make sense. Small caps from a historical standpoint, the reason why we've liked them so much and the reason why we're probably going to continue to add to it as we go through the back half of this year, and it's already an overweight in a pretty big way for our customers. The reason why it's in our accounts and the reason why it's done so well today is from a historical perspective. So every time from a historical perspective that we've gone through a rate cutting cycle, that first rate cut has propelled small caps as an outperformer, even more so than large cap tech. Maybe not by a lot on large cap tech, but certainly an outperformer from a historical standpoint. We've talked about that small caps have underperformed the S&P 500 for 13 straight years. Well, when was the last time that small caps outperformed? You have to go all the way back to 2001 through 2011. So what happened? In 2000, we had a dot-com bubble burst, right? There was all this exuberance of the internet and tech stocks. Anything dot-com with no sales was trading over 100 times their price to earnings ratio, right?
There
Just
was so much
crazy.
.com.
Yeah,
So much
it was
.com.
craziness. So you had this market meltdown, 80% loss in the NASDAQ, a 50% loss in the S&P 500. Well, what's different this time? The Fed had to cut rates because of that debacle with the dot-com bubble that had burst to rescue the economy and the stock market. That's what happened. They cut for a bad reason. Well, what's different this time? The Fed's trying to cut for a good reason, right? We still have really good employment, really good GDP, really, really good corporate earnings. And now inflation's under control. Therefore, it makes no sense to keep interest rates as elevated as they are. So cutting rates under these circumstances should be the most bullish thing of all time. It certainly was for small caps today, and I expect that to continue throughout the back half of this year. And if I were a betting man, which I am not, I would be willing to wager that the small caps likely would outperform everything else throughout the back half of this year. And the cool part about that is it doesn't take a long time. Again, I know small caps have underperformed the S&P for 13 years. But if we go back to that 2001 example, when the Fed started to cut rates, small caps outperformed the S&P 500 for the next 10 years on average by 6% a year, and the cumulative outperformance was more than 100%. Okay? Then there was this 13-year period where small caps lost you a whole bunch of money and significantly underperformed. This really looks like, to me, another window. Don't know if it's going to go a decade or not, but it looks like a certain window where small caps really can shine and outperform. And to your point, as that small cap ETF that I talked about, the IWM that we own for our customers here in a big way, 30% of that index is banks. These are smaller banks, community banks, regional banks. They're all publicly traded, right? They're just smaller than JP Morgan and everybody else that you're familiar with. Well, 30% of that index is banks. And that helped do exceptionally well here today. So we look at something like the KRE, which is an ETF that tracks regional banks, that did better than small caps today. That was up 4.21% to answer your question, as it absolutely knocked out of the park. And again, by owning the Russell 2000, we get two bangs for a buck here. We get a huge chunk of exposure to financials through that position. Plus, we get the historical benefits of small caps doing really, really well, typically outperforming everything. We go through a rate cutting cycle, and specifically during that first interest rate cut. So I get it. We should have saw a big move in financials. We should have saw a big move in small caps. We saw a really nice move in industrial stocks today. The industrial sector was up 1.27%. And really big companies like Caterpillar were almost up 1%. So manufacturing is another place that we have exposure to for our clients that's overweight the S&P 500, which should do well, right? Historically, when you get interest rate cuts, you're talking about manufacturing. Manufacturing is an extremely labor-intensive business. And when cost of capital comes down, that's immediate relief for manufacturers. Demand goes up because now they can be more efficient in the way that they build things. The demand for orders should go up because the cost of borrowing is coming down. All of this stuff is extremely bullish for the economy, but only a couple of sectors really played ball today. But the one that played the best from a sector standpoint was housing. So ticker symbol ITB is what we own for our customers. It's the iShares U.S. Home Construction ETF. Again, we already know that there's a major housing shortage in this country. Interest rates coming down, the demand for building new homes goes up. They can now borrow from these smaller banks as home builders can. All of this is leading to, I think, a better second half of the year than even what we had in the first half. And we had a great first half of the year. S&P 500 up approximately 15, 16%, something like that. That's awesome. That's not normal for the first 6 months of any year. But now we're likely going to go through this aggressive rate cutting cycle due to the huge drop in inflation that we've seen here this morning. And I expect that to continue throughout the remainder of the year. I mean, who actually would think at this point in time that owner's equivalent rent is going to spike or home insurance is going to all of a sudden spike all of a sudden? None of this makes sense. If you are looking at the market right now and questioning if this is truly the path of inflation, you truly need to step away from the computer and fire yourself from making any future trades in the portfolio, because history's not on your side, and neither is any of the data, both real-time data and the prior data that we've already received throughout the first 6 months of this year. I know I've said a lot, and I've pretty much got all the stress off of my shoulders here from today's market reaction. It was extremely frustrating, no question about it, but it's just one day. And here at Shepherd Wealth Management, we did outperform the S&P 500 in a pretty big way today, even though things were down across the board. Still significant outperformance because of the weightings that we have in things like small caps and industrials. But definitely disappointed, right? You shouldn't see the best, most profitable companies on the planet from a tech perspective when AI is, the next revolution here, not just for this country, but for the entire planet. I can't imagine somebody like, yeah, I don't want anything to do with Microsoft today. I'm going to sell that thing and I'm going to go buy small caps. Yeah, buy small caps. But, Microsoft has a pretty good business too.
Yeah, maybe just go buy small caps. Skip that first part.
So it's fun. It's fun for a couple of reasons. One, I really do love and enjoy my job, and I get to spend time with customers the way I want to, and it's just a lot of fun. It's a lot of fun to do this program, but it's certainly from a day-to-day basis, if you were just looking at things one day at a time as opposed to looking at it as an aggregate and kind of taking things from a holistic perspective, looking at the market daily certainly can drive one crazy because it's made up of human beings, and human beings are extremely emotional. And oftentimes, the decisions that are made on a day in and day out basis, one day at a time, are not very logical in any way, shape, or form. But what that does provide you, for those that do the homework, that do the research, that look at things from a historical lens and apply the fundamental, technical, historical data around their process for making decisions, this certainly provides a lot of opportunity. To do the right thing for yourself, your family, or whatever the reasons are that you're actually putting your capital at risk in the stock market. So with that, I do look forward to the back half of this year. We'll continue to do these programs every couple of weeks. We get PPI, the wholesale inflation number tomorrow, the producer price index. That was negative last time we got the number. I expect it to continue to be probably in a negative territory. So there's a decent chance that tomorrow we actually get a nice little run up again. Historically, July is actually a very bullish month, specifically for election years. Turn is north of 1%. So July historically actually is, in fact, a great time to be a market participant. And today you got the tech sector on sale by nearly 2%. So, if you're still sitting on the sidelines, like a lot of you are, $6 trillion still sitting in cash. Like, that's the crazy thing too, as like $6 trillion sitting there getting 5% when the market's up 18. Right? Last year it was up 24%. Everybody was sitting there 5% money markets, feeling all good. Thought the world was going to come to an end multiple different ways. And none of that shit happened, man. Our clients were up about 35% on average. The market was up 24%, and you guys are clipping 5% coupon. So something's got to change. And the cool part is when that $6 trillion starts to hit the market, tech, small caps, like everything else we just talked about, home builders, we're already there. I'll ride the wave, and then I'll do exactly what Warren Buffett talked about. I'm going to be fearful when others get greedy, right? When you see that margin debt start to spike because people are taking on leverage because they feel so good about the market. People are really waiting for things to be, quote, perfect. Well, by the time they're perfect, you've already missed out on 20% gain, and you might catch that last little 10%. I'm going to catch it too in a bigger way. I'm also going to get out in a smart way for our customers before the other shoe drops, because that's inevitably what will likely happen. Is all this exuberance will lead to an overvaluation. Now, the exuberance and momentum can last quite a lot longer than what a lot of individual investors think. So it's not like just because people start to buy stocks, you got to get out. You got to do it smart. And we'll talk about some of that as we approach that period of time when I think it's actually a time to talk about that. But no question about it. It's fascinating watching this live autopsy called the stock market of how human beings make decisions. So this is everything that I needed to get off my shoulders today. I hope everybody feels a little bit better. I feel better.
We need to keep doing this at 4 on the days when we drop data. So
Crazy. We'll have to do this again next time, but I feel better. I hope everybody listening is smarter, making better decisions for themselves. And truthfully, I know we joke around a little bit today, but if this isn't something that you're comfortable with, if it makes a lot of sense, I need to get my arms around it. I need to take advantage of some of this. 513-630-2664. Give me a call. I'm happy to help. And I look forward to continuing to do this every couple of weeks. So with that, Ez, I don't know if we have anything to leave the audience with. Any updates on our end about anything?
no.
I didn't think so. So as we get any news, we'll share it. But we'll do this in a couple of weeks from now. We'll be right actually makes an announcement on the path of interest rates. So look forward to sharing all that information with you all. And I hope you guys are enjoying the program. Don't forget to subscribe, hit the notification button on YouTube, or just simply go to shepherdwm.com. There's a bunch of links right at the top of the website. They take you right to Spotify, right to a YouTube channel, so you can check out both this podcast and prior podcasts if you missed them. So hope you guys have a great rest of your Thursday, and we'll see you again in a couple of weeks. Take care.